Did you know the wealthy and people on the way to getting rich use coupon books too? But the coupon books they found can save them millions. Let me tell you what it is and how it can help make you even richer. What's the name of that coupon book? The tax code. The rules that determine how you and I pay taxes on what we make. Now, what do I mean the tax code is like a coupon book? We pay for government services. Those payments are called taxes. And because most Americans don't itemize, the majority of us pay retail or full price for those government services. In fact, most of us overpay. That's what our tax refund is. The average tax refund in 2024 was $3,138. That's about $3,000 that we could have used for something else, including investing and saving for retirement. While it's taking a huge chunk of your paycheck, some people, including the wealthy, are getting discounts. We see stories about billionaires paying less in taxes than teachers or paying nothing at all. Why? Because they know and take time to use features of the tax code to clip out savings for themselves. Jeff Bezos, one of the world's richest people with over $18 billion, was able to use the tax code to get a $4,000 tax credit intended for families earning less than $100,000. One reason is that the tax code tends to treat wealth assets and capital differently from income earned by labor. Bezos' net worth is largely tied to stocks and assets and not income, and how his income and wealth are presented when he files taxes can make his taxable income look much smaller. Warren Buffett famously pointed out that he paid a smaller tax rate than his secretary. Now, how can they get away with this? And why can't you? That's because they're playing a completely different game with the rules most of us don't even know exist or just don't take advantage of. They're metaphorically looking in the tax code, clipping legal deductions from government tax law and regulations, and redeeming them like a coupon on their taxes. Now, why don't many of us do this to save money and direct more towards wealth? Most of us do our taxes with a sense of pre-surrender, as if to say, just tell me what I have to pay. For many of us, that means simply using the standard deduction. According to a 2020 IRS report, that's what 90% of taxpayers do. When we do that, we often give up the opportunity to itemize. So most of us who give up pay retail. Where we give up is where people like Bezos, Elon Musk, Warren Buffett, and even more people around you start playing the game. What do I mean by the game? The game means that you can essentially and legally follow and use the rules of the tax code to hack the tax code in order to optimize it and help you save on taxes, as long as you do it legally. So consult your tax professional to make sure you do. People who optimize points from credit cards can relate to this. While some use a card as a simple product and simply pay off their credit cards, some in the credit card community actively plan and build out ways to find deals that allow them to get money or buy vacations and trips that they couldn't get before. Same vehicle, a credit card, engaged by different people to get different results. Like credit cards, it's the mindset and rule following that can help you get more from your taxes. Or, as comedian George Carlin once said, you have to pay your taxes, but nobody said you have to leave a tip. Here are 5 specific concepts rich people use to legally pay less in taxes and build massive wealth at the same time. While some of the ideas may be both legal and valid, the tax code in your specific situation could be different and should be reviewed by a tax professional. 1. Itemize instead of the standard deduction. As I mentioned, 9 out of 10 taxpayers opt for the standard deduction. But if you do optimize, you may be able to save more on taxes year after year. Those savings can build up and accelerate your path to retirement. 2. Have a business. Business owners get access to deductions that W-2 employees, that's people who get a paycheck, simply don't. As a broad concept for legal and tax purposes, the business is often considered to be like a separate person, a person separate from the people that actually work for it, often including the owners. With this structure, the business has the ability to spend and deduct items and services in a way that might be disallowed or that would be taxable if you did it as an individual. Because a business can be structured to pay you as a person separate from the company, it can also affect your personal tax rate. 3. Have certain assets. The government may allow deductions around certain types of property you own. One of them is real estate. Many homeowners can take a deduction on their mortgage and, to some degree, property taxes. Another type of asset is stock. A stock is a share of a company that allows you to claim a portion of a company's value or profits. If you own a stock, the government may let you deduct a limited level of losses each year to reduce your tax burden. 4. Tax-deferred accounts. By adding money into approved tax-deferred accounts like an IRA, the government may allow you to deduct that contribution on your current year taxes. 5. Donations. By giving, you can get deductions to reduce your taxable income. For example, if you have stock, you can give that stock to an approved charity and deduct the contribution. The crazy part? Most of these strategies are completely legal and were intentionally written into the tax code. Now, I'm not saying the system is fair. That's a whole different conversation. But understanding these strategies can help you see why wealth inequality between those that work and those who own stocks or assets keeps growing further apart. And it gives you some tax strategy ideas for your own financial journey as you build wealth. So talk to your tax professional, and if it helps, start clipping. If you found this helpful, drop a like and subscribe. And let me know in the comments which strategy surprised you the most. Thanks for watching. I'll see you in the next video.